Before going into the topic details, I want to bring your attention to the UPSC coaching programs offered by ClearIAS. ClearIAS offers online and offline courses to help candidates get selected for prestigious government services like IAS, IPS, or IFS. ClearIAS, Prelims cum Mains, PCM course, provides a highly effective study plan, well-organized subject-wise videos, study materials, mock exams, and guidance to cover the entire GS syllabus of UPSC CSE Prelims, Mains, and Interview systematically. As a limited period offer, there is a 40% discount on our online courses. Enroll now.
We'll deal with the topic control inflation. We have to control inflation. How can we control inflation? So that is what everything is connected, right from the definition of economics to the subtopics of it. I am just connecting it like a thread. So if you just remember that thread, everything is crystal clear, right? You can understand everything. So it's very simple also. So we have to control inflation. So who can control inflation? Can you control inflation? You may not, as individuals, we don't have much control over the price of other items, right? So who can control it? At a macro level, two agencies can control. Who can? One? Perfect. One, Reserve Bank of India can control. Second, Government of India can control. If price is high, it should be controlled. Only two major agencies which deals with the control of inflation are RBI and Government of India. And if RBI does this control activity, that comes under monetary policy of India. And if government does it, what is it called? Is it called fiscal policy? Fiscal policy. And every prelims question will have some very simple questions as well. Maybe if there are 100 questions, maybe 10 questions will be like sitters. We call it the sitters, like a very easy question. And some question can be like this. The fiscal policy of India is managed by 1, 2, 3, 4. There can be RBI, it can be Government of India, or there can be the Secretary of Finance or something like that will be mentioned. But if it's a very, very simple question, but you should not miss such simple questions. That's why we should understand it. It's a very basic question. What happens is that sometimes, even though very real serious aspirants, they will miss out on these very simple terms. So this is why we should be studying monetary policy of India and fiscal policy of India. It is connected with inflation. In addition to fiscal policy and monetary policy, there is another aspect which the government can take to control inflation. Have you heard about that? Instead of policy measures, government can also take some administrative measures. Administrative measures is because sometimes the producers or the wholesalers or the middlemen may try to artificially create scarcity in the market. They may do activities like hoarding, black market. So there is, even the monetary policy will not help or the fiscal policy will not help. So at that time, the government has to intervene and do some administrative measures, identify who is hoarding the essential commodities, or is there any other thing that is happening, like a collusion of the main producers or any other illegal things happening in the market. Government has to verify and curtail it. That is through the administrative measures. That is the third way of controlling inflation. But mostly we will not be going to that area. We will be mostly sticking to monetary policy and fiscal policy. Let's deal with the monetary policy. So monetary policy deals with the steps taken by the Reserve Bank of India primarily to control inflation. There are other aspects of monetary policy. It is not just focused on monetary policy. The Reserve Bank has many other functions, but for time being, I will connect it with only with the inflation aspect. So the main role of RBI is to keep inflation in check. At the targeted rate of around 4%. So that is the rate. So if inflation rate goes high, government RBI will try to intervene. Then what will RBI do? Will RBI increase interest rate or decrease interest rate? If inflation is high? This can be a prelims question. If inflation is high, what will government do, RBI do with interest rate increases, right? So, why RBI increases inflation rate? We'll see that. We'll see a hypothetical case. So, inflation is high means the demand is high, the supply can be less, right? Or there can be another case also. The other case is that there is too much money in the hands of individuals. Everybody pocket has a lot of money, so he is able to readily spend it, right? So we have who are the online students now. So Tilotama has a lot of money. Ashish has a lot of money. Suppose Rahul has a lot of money. Then what happens? So everybody has a lot of money. They are also ready to spend. So naturally, the price will go high because they have liquid money. The more liquid money every individual has, the tendency to spend it is also high. So inflation will also go high. So this thing you have to be very clear. Okay, in connection with demand and supply. If the demand or the supply of the money is high, then also inflation will go high. Or the more liquid money every individual has, inflation will go high. So the RBI has to take steps to limit the amount of money, liquid money everybody has in their pockets. Okay. So what will they do? They will increase the rate of interest they get. So suppose the rate of interest, suppose I have rupees 100 in my pocket. Okay, if I have 100 in the pocket and the rate of interest in bank is only, let's say, 1%, I will be very least bothered about that 1% interest rate. If I have 100 rupees in my pocket, I can use it anytime I want. But if I put it in the bank, in the savings deposit or in the fixed deposit, let's say the fixed deposit rate is only 1%. So I may not even care. Like 1% is the rate of interest I am getting if I am putting it in the fixed deposit. Better I keep it in my pocket and spend it when I want. I may not be bothered to get that. So naturally, I will be spending more in the market and to some extent, I will be creating inflation as such. But suppose the government says that instead of 1%, you are getting 10% interest rate if you keep that money in the bank. So then I will be tempted. I am getting now 10% in the market. If I spend it, that money will be gone. But if I am keeping that money in the bank, my 100 rupees will be, if in this case, it will become 101 next year. In this case, it will become 110 next year. So I will become richer if I keep the money in the bank. So I will be tempted to keep the money. I will be tempted to park my money in the fixed deposits. So what happens? Government is sucking the liquidity out from the market. Government is taking the liquidity out from the market and government is getting a lot of money in the banks, in the fixed deposit. So fixed deposit, people have a less tendency to break it because that will remain there. So the liquidity from the market is being sucked out by RBI. So if there is more liquidity in the market, then inflation will go high. If there is less liquidity, inflation will come down. So in this case, if the inflation is high, what the online student said is the correct. If inflation is high, the interest rate also should be high to reduce inflation. So with respect to this interest rate, you might have learned a lot of terms like repo rate, reverse repo rate. I want to give an overview that through the different rates, government will control the inflation rate. If inflation is high, government will increase the repo rate like that. So if government want to decrease the inflation is high, then government has to bring down the inflation, right? To bring down the inflation, it has to increase the interest rate. And the reverse also will be applicable on the reverse scenario. But this is a core concept, that equation, like you should understand what should be the next step should be taken.